the questions that I posted to the message board. And remember, these could have been on your exam. Every question that we see tonight could have been an exam question. Some of them still might actually appear on your exam, but probably not too many, maybe one or two at most. But the thing is that these could have been exam questions. There are really probably one or two of these questions that are a little bit more complex than I would have felt comfortable putting on the exam, but most of these are questions that I would feel quite comfortable putting in the exam, including question number 1. An investor is considering a project that will generate $900,000 per year for 4 years. In addition to upfront costs, in the 5th year there will be a shutdown cost of $400,000. If the cost of capital is 4.4%, what is the upfront cost necessary to make the project worthwhile? Okay, well, we can start. I'm going to be doing everything in Excel. A lot of these you can probably do in a financial calculator just as well, but I'm going to be doing all of them in Excel. What I always like to do, even before I try to figure out how to do something, is to write down what I have. We know that for 4 years, year 1, year 2, year 3, year 4, we're generating $900,000 per year. So I'm going to say $900,000, $900,000, $900,000. And then in the 5th year, what's happening in the 5th year? In the 5th year, we're losing how much? We're losing $400,000, right? So I'm going to put all of this in dollar signs again just to make it make sense. Okay, there we go. So we got 5 years over here, 900,000, 900,000, 900,000, 900,000, then losing 400,000. And we have a cost of capital here. We have a rate, 4.4%. And what upfront costs are to make this project worthwhile? Okay, what formula are we going to use? In other words, what are we looking for in order to justify upfront costs? We're looking for present value, right? Not necessarily the future value, we're looking for present value. The value of what it's worth right now. Now in this case, because you have different... There are really two ways to do it. Number one, you could use the regular present value formula and then subtract $400,000 of future value. The easier way to do it is simply to use the net present value formula. If I go equals NPV, net present value, this again, we're talking about uneven cash flows. Even though most of the cash flows are the same, the last cash flow is different. So all we have to do is put in the rate. Now in this case it tells us that the cost of capital is 4.4%, which is 0.044, or I could put put 4.4%. Either way would be fine. And then I can establish all the cash flows. And remember, in Excel, when you talk about cash flows, it means from the end of year 1, which is what we're looking for here as well. I can stick all of these in here, and now I can close the parentheses, and my net present value altogether is $2,913,821.25, which of course is our answer. That is the upfront costs that makes the project worthwhile. Anything more than that, it's not worthwhile. Anything less than that, it is worthwhile. If it's exactly that, then it's a break-even project, which I guess doesn't make it very worthwhile, but still that would be the answer that you're looking for. Question number 2. A farmer sows a certain crop. It costs $240,000 to buy the seed, prepare the ground, sow the crop. In 1 year's time, it will cost $93,200 to harvest the crop. If the crop would be worth $350,000 and the interest rate is 7%, what is the net present value of the investment? Okay, let's write this out over here. So we have, let's start our upfront costs. Our upfront cost is $240,000. We can write that down. We can say our cost in 1 year, again, I'm just writing it down. I'm not even applying any formulas yet. I'm just putting it in over here, is $93,200. And our gain, our profit, or I should say what we make is $350,000. Okay, so we're going to try to find out what is the present value of this entire transaction. Both of these are, of course, negatives, and this, of course, is a positive. And, of course, that is true. Our rate, we are told in the question, is 7%. All right. So what formula can we use over here? Well, the truth is we can't really use a net present value because the cost is up front, and in Excel the net present. We can, in a financial calculator we actually could use it. In Excel, I'll do this on a financial calculator. The way I would do it in a financial calculator. Let's bring up the financial calculator over here. Remember, because in a financial calculator, when you use the net present value formula, the zeroth cost is over here. Actually, well, you know what? It's better. We're better off doing it this way. Yeah, we could do it that way, but I think the easier way to do it here would be to simply say, okay, what is the present value of this cash flow? Our cost in a year is $93,200. Our profit is $350. So what is our net profit after 1 year? After 1 year. What's our next net profit after 1 year? How much are we making after a year? We have a $93,200 cost. We have a $350,000 profit. So what we're actually making after a year is the profit minus the cost. So this is the amount that we're making after 1 year, right? So at 7%, let's figure out what our present value is. Remember, we're going to measure it up against this. This is going to be our upfront cost. So how much is this worth in a year from now? And for that, again, we're looking at the present value, so that we can use the present value formula. The rate is 7%, so I'll just put in there. Our number of periods is what? Just one. 1 year, right? Our payment, we don't really have a payment. Our future value is $350, right? I'm sorry, our future value is $256, $350 minus the 92. So we can say this. The type is 0 because it's at the end of the year as usual. And it looks like our present value is $240. It's negative because we put in future value as positive, but so what does that tell us about the net present value of the investment? It's 0. Does everybody see why it's 0? It's 0 because our present value is $240, and our costs are also $240. So overall, we break even. So this question was simply a matter of saying, okay, this $350 minus $93,200, this $256,800 in a year is worth what to us now? And at 7%, the present value formula tells us that it's worth $240,000, and it costs $240,000. So therefore, the net present value of the investment is exactly 0. Okay, question number 3. I'm sorry if the text here is a little small. Hopefully you had a chance to print it out, or if it was on the message board, or you can still print it out, I guess, if you like. Temporary Housing Services Incorporated is considering a project that involves setting up a temporary housing facility in an area recently damaged by a hurricane. It will lease space in this facility to various agencies, and it estimates that the project will initially cost $2 million to set up. So first of all, I'm going to get rid of these. These numbers don't really help us at all. So let's say, again, I'm just going to put in all my, I highly recommend when you do the exam you have the in Excel spreadsheet open for you. So our initial cost is $6 million. Okay. All right. Okay. And it will generate $22 million in revenues during its first and only year of operation. It's 1 year, so revenues are $22 million. Okay. What else does it say? Okay. And operating expenses are expected to be $11 million. So operating expenses are $11 million. Again, so far I'm just writing in the numbers. So far I'm not doing any calculations. Let's put this in dollar signs. All right. Operating expenses are $11 million. And depreciation is $2 million. Okay. And what else does it tell us? It doesn't tell us anything other than the marginal tax rate, which it tells us is 35%. So this is all the information it gives us. So what is the free cash flow? Okay, does anybody remember the formula, ignoring the first $5 million of the initial costs? Okay, so should we just cut? Did I say 5 million or 6 million? I thought it's all right, whatever. Anyway, it told us to ignore it anyway, so who cares? So we can just cut the whole thing. It makes no difference. So we don't have to worry about that anyway. Okay, so how do you figure out the free cash flow? Anybody remember the free cash flow formula? Again, this is something that you should hopefully have printed out for yourself. You know, we spent like a half a class discussing the free cash flow formula. The free cash formula was our EBIT, our earnings before income and taxes, minus our taxes, and then plus whatever depreciation there was. So what's our overall net? What's our net revenues? Our net revenues, of course, is our revenues minus our operating expenses. So our net revenues are 11 million. Hopefully it's obvious why that is. If we spent 11 to make 22, then our net revenues are $1 million. Now, before we figure out taxes, what do we have to do? Before we figure out what the taxes will be. First thing we have to do is we have to also subtract the depreciation. Minus the depreciation, because, one second, there shouldn't be an equal sign there, okay. Alright, anyway, let me just write it. Minus, Excel thinks it's a formula. Okay, minus depreciation. The depreciation is 2 million. So that means that our EBIT, which is our earnings before income and taxes, is our revenues minus our depreciation, which of course is 9 million, that's correct. Now we got to figure out our taxes. And our taxes are 35% of our EBIT. That's our earnings before interest and taxes. So it would be this amount times 35%, so this would be our taxes. Now our revenue after taxes, what do we have left after taxes? Okay, again we're going to have to add back the depreciation in a minute, that's correct. But even before we do that, let's add them up. So let's take the taxes off. And now we have to add back the depreciation. And again, the reason is because we took the depreciation just for the purpose of figuring out what the taxes are, but the depreciation money doesn't really come out of our pocket in order to figure out the free cash flow. So let's add back the depreciation, which is 2 million. And that gets us our free cash flow. Remember, free cash flow is how much money we're actually getting, how much money we actually have in our pockets coming from this year. And the total becomes $7.85 million. Again, all the information you need, obviously, to get the answer to the question is going to be in the question. Just a matter of, even if you don't specifically remember the formula, you should have the formulas in front of you, of course, but even if you don't specifically remember the formula, hopefully you could have done this logically. You know, our net revenues are 11 million because it's revenues minus the expenses. Then you subtract the depreciation in order to figure out the taxes. So we figured out the taxes, which is 35% of our EBIT. Subtract that, add back the depreciation, and now you've got your free cash flow. If there were interest expenses or net working capital, you'd have to adjust for those at the end, but thankfully we didn't have those in this question, so we didn't have to worry about it. Question 4. Okay, Cameron Industries is purchasing a new chemical vapor depositor to make silicon chips. It will cost $4 million to buy the machine. All right, what's the cost of the machine? It is $4 million. And $12,000 to have it delivered and installed. All right, let's make this dollars also. Okay. All right. And building a clean room in the plant will cost an additional $3 million. Just putting in that for $3 million. All right. The machine is expected to have a working life of 6 years. If straight-line depreciation is used, what is the yearly depreciation expenses in this case? What does straight-line depreciation mean? Everybody remember? Straight-line depreciation means simply you depreciate it equally each year over the course of its entire life. What is the total amount that you're allowed to depreciate? Whatever it costs you to build. You can't depreciate the land costs, but things like building a room and delivery. Basically, this whole thing, to build this, cost you the sum of all these things. So the whole thing to build cost $7,012,000, $4 million for the machine, $12,000 for delivery, and $3 million for building a room. If you depreciate it over the life of 6 years, how do you figure out the yearly depreciation? Can anybody figure this out? Again, it's a fairly easy, fairly logical question. You got to divide by 6, exactly. You just take it and divide it over the course of 6 years. So do this divided by 6, and away you go. Our yearly depreciation, let's put it in dollar signs, $1,168,666.67. Simple enough? Okay. Hopefully that was simple enough, because the next question is anything but simple. This one might have given you a little bit of a hard time, which is fine. This was one of the two that I think are a little bit more complex than I'd feel comfortable giving on a test. So this one is not on the test, but still we can work through it a little bit here. I'm going to make it a little smaller. It gives you a little chart over here. And the chart says that it's expected to grow at a rapid rate over the next 3 years, and it shows based on the chart, but settle at a growth rate of 5% in year 4. The spreadsheet above shows a simplified pro forma for the tobacco industries, and they have a weighted asset cost of capital of 11%, $40 million in cash, $70 million in debt, and 18 million shares outstanding. Okay, now, of course, one thing that if you got a question this complicated, and the reason why I probably wouldn't give this on an exam is simply because it would take you so long to fill in these things. Fortunately, I did that. Let's see. Let me stick it in over here. All right, there we go. This is basically just a copy of what you see in front of you over there. Nothing really more complicated than that. All right. So, and the free cash flow numbers, of course, are on the bottom over here, which in the problem over there is underneath the little line over there. All right. So then they ask you, so if Banco Industries can reduce its operating expenses so that EBIT becomes 12% of sales instead of 10% of sales, in the original example it gives us 10% of sales. If you notice, the EBIT over here is 10% of whatever the sales are. This is in millions, of course. It was this 270 million, so the EBIT is 27 million, etc. So it's 1/10 of whatever this is over here, and then it has growth from the previous year. This is all this is, by the way. They give it to you in the question, but all this is, it's the difference between this and this divided by the original number. Basically, it's 30, which is the growth, divided by 240. And if you can see the formula over here, this is 290 minus 270 divided by 270. Again, it's the growth of 2 over 1. This is the growth of 3 over 2. 3 over 2 grew 20 million. So 20 million divided by 290 million is 6.9%. Each year you're growing a little bit, and then after year 4 you're steadily growing at 5% thereafter. So the first thing you got to figure out is, based on this, what is the stock price? So to figure out the stock price, you need to figure out the total present value of all the cash flows. If you recall, again, this is one of the formulas that we discussed earlier in the course. Let me write it down over here. Okay, 1 second. Let me write that down over here. The stock price is the present value of the cash flow plus the cash on hand minus your debts divided by the number of shares. And again, this was something that did appear in one of the classes that we discussed. Maybe it was class 10, maybe it was class 11, I forget. But anyway, that's what you'd have to figure out. Okay, so the first thing you need to figure out the present value of all of the cash flows. Now, in order to figure that out, though, you have the first 4 cash flows, but what about thereafter? How would you figure out the cash flows, or the value, really, at the end of year 4? How would you figure that out? For that, it would have to be a perpetuity. That's correct. You know, we can use these same numbers. Remember, this is at the end of year 4, so we can use the same sales numbers. The sales numbers are this. The EBIT, of course, is this. The growth is irrelevant because it is at the end of year 4. So we can use the same year 4 numbers, of course. So in order to figure out a perpetuity, what's the formula for a perpetuity? It is the cash flow divided by the rate minus the growth. How would we figure that out? Okay, what's the cash flow? At the end of year 4, the perpetuity, what would be the cash flow for the perpetuity? What would be the cash flow that's the base of the perpetuity? The answer is it's your earnings. It's your EBIT. That's the general, whenever you're talking about a cash flow. Cash flow is essentially the same thing as your EBIT. Again, so, you know, not accounting for the income tax, but the point is you can use this as your EBIT. You can use this as your earnings. And then we can divide that by the rate minus the growth. What is the rate? Well, the question tells us that the cost of capital, the weighted average cost of capital is 11%. What's the growth rate? Well, the question also tells us that the growth rate is 5%. So 11% minus 5%, of course, is 6%, which means that the value at the end is $542.5 million. Again, these are all in millions, obviously. So how would we figure out the net present value of the cash flow? Right now, we're trying to figure out right this second. So right now, how would we figure out the net present value of the cash flow? Okay. The answer is we could use the net present value formula. Right. So I'll say the net present value of cash flows, and I'll use the Npv formula. What's our rate? The rate is the cost of capital. Whenever you're talking about a company or business, the rate is the cost of capital. And it tells us that our cost of capital is 11%, right? So we'll say 0.11 times the value of the cash flows, and we can start from here and put in all the cash flows here. And it turns out that the net present value of our cash flows turns out to be $371 million. $371.72 million. Okay. Fine. Now let's figure out the stock price. And of course the price is the present value of our cash flows, which is this. Let's plus our debt, plus our cash minus our debt. And the question tells us that our cash is 40 million and our debt is 70 million. So we add 40, then subtract 70, which turns out to be a net of minus 30, and again we're in millions. And then we can divide that by our number of shares, which is 18 million. So I'm just going to leave it as 18 again because we're talking about in millions in general. And it turns out that our price in terms of dollars becomes $18.98 per share. But that wasn't the end of the question. The end of the question is, what changes? By how much will it increase if our EBIT becomes 12% of sales instead of 10? Well, okay. Let's leave this aside. Let's leave our stock price as, our original stock price as 18.98. Let's leave that as it may be. And now instead of our EBIT being 10% of sales, now we're going to make it 12%. In all of these formulas over here, this was 10% times this. This was 10%, 0.1 times this. This was 10% times this. So let's simply change all these formulas. Instead of being 10%, we can change it to 0.12, which is 12%. And we can just simply change this, this, and this, and of course this. We can simply change them all to 12% and just use the same formulas. We don't have to change anything else. By increasing our EBIT to 12%, everything went up. And because everything went up, the present value of the cash flows became higher. And because of that, the price per share became higher. So essentially what happened is our share price went up by $4.23. So again, this was a fairly complex problem, but such as it is. All right. Question number 6. Conundrum mining. Let me keep that sheet for later on, just in case. And I'll get a new sheet over here. Okay. Conundrum mining is expected to generate free cash flows for the 4 years, after which they're expected to grow at a rate of 6% per year. If the weighted average cost of capital is 12% and they have cash of $80 million, this is kind of similar to the previous question, except it's a lot easier because they give you the free cash flows. So I actually have this in another window here, so I'm just going to stick the free cash flows. And again, this just becomes much easier. It's the same kind of question as the previous question, but they skipped a whole bunch of steps. You don't have to figure out anything for yourself. The only thing you have to figure out is everything after, like basically it's just the last 2 steps of the last question, right? All right. So what we need to figure out is the present value of the cash flows, just like we discussed last time. So I'll say value at the end of year 4. So the value at the end of year 4 is what? It's the value of the cash flows at the end of year 4 it's a perpetuity. So I'm going to say equals 26, which is the cash flow, divided by the rate minus the growth. And it tells us in the question that the expected growth rate is 6% and the weighted average cost of capital is 12%, which means that the 12% minus 6% is 6%, which means that the present value of the perpetuity is $4.33. And we can put this all in dollar signs if we like. Okay. And now we can figure out the net present value of all of the cash flows, just like we did last question. This next present value of cash flows, and here let us use the net present value formula. Rate is our cost of capital, which we're told in the question is 12%. The values are simply these, and it turns out that our net present value of our cash flows is $303 million, $303.13 million. And so now we can figure out the share price. The share price is what? As we discussed in the last question, it's the net present value plus the assets minus the debts divided by the number of shares. So we can start with the net present value of the cash flows. Equals this, put in parentheses because I want the whole thing divided by, plus the cash, which is 80 million, minus the debt, which is 60 million. Terminal enterprise value simply means how much money is it worth. So you don't even need to divide the number of shares. Really the truth is this would be the answer. They didn't even ask for the share price. So this would be the answer because this is how much it's worth right now. It's worth the value of the cash flows plus its debt minus its, plus its cash minus its debt. If you wanted to figure out the number of shares, what each share is worth, just take this and divide by the number of shares, which is 30 million, and it turns out the individual share price is $10.77. Same question as last time, except they did the first 3 or 4 steps for you here. All right. Question number 7. All right. Ford Motor Company has realized returns of 10%, 20%, negative 10%, and negative 10%, which are right here for the last 4 years. Okay. Year 1, Year 2, Year 3, Year 4, and they ask you for the standard deviation. Now, there's the easy way to do this, and there's the hard way to do it. The hard way to do it is to calculate the mean, and then see how far each one is away from the mean, and take the square of that, and divide, and do all that. Or you can just ask Excel to do it for you. That's the great thing about being able to use Excel here, is Excel has a standard deviation formula. All you do is press equals STDEV, open the parentheses, take all your values, and Excel tells you that the standard deviation is 0.15, or if you're talking about in percentages, it would be 15%. So the standard deviation, which is important, of course, in figuring out a stock's beta, which is important in figuring out the volatility of a stock, how risky it is, but figuring out the standard deviation in Excel is extremely easy. If I were you, I would hope to get a couple of these questions on the test, because these could not be any easier. All you do is stick it in its Excel, apply the standard deviation formula. The whole question shouldn't take you more than a minute. All right, number 8. Okay, suppose you invested $60 in dividend stock DVY a month ago. If it paid a dividend, I'm not sure why it's getting cut off at the end over there. Yeah, I'm sorry, I don't know why this, how about if well, no, that wouldn't help. Alright, well, hopefully you should be able to see it. Suppose you invested $60 in the shares of dividend stock DVY a month ago. Its dividend today, it paid it, it's really cut off badly over here. Sorry if you didn't if you didn't happen to download it. It says I have printed out over here the dividend of 63 cents today, and then you sold it for $65. So in other words, you bought, let's say, I'll say the buy price is $60, and that's dollars, not percentage. All right. Then the dividend, which it says is 63 cents. Again, okay, 63 cents. And then its sale price is $65. All right, so what do they ask? They ask, what is the return on your investment? Okay, how do you figure out the return on an investment? This is easy because it's just 1 year. You don't even have to worry about present values or anything like that. Well, you got to add the dividend plus the capital gain. Or yeah, it's even 1 month. Okay, so it's only one period. The point is you don't have to worry about right. So you don't even have to worry about number of periods. Just simply take your capital gain, add your dividend, and divide by the original price, and then you figure out the return on your investment, your ROI. So, your ROI, what's your capital gain? Your capital gain is $5, right? 65 minus 5. So I'll say 5 plus my dividend, which is 63 cents, that's 0.63, divided by my buy price, which is $60. And it turns out that my percentage is, I have to do equals, of course. If you don't do equals, Excel doesn't know that it's a formula. And it becomes this. If I convert it into percentages and I expand it a little bit, it becomes approximately 9.38%. Okay? Simple enough? All right. Next question. Question number 9. And again, I'm sorry, I don't know why this is not. Let me see if I have the PowerPoint, because it's getting cut off for some reason. Huh. All right, I'm just gonna load this up. It may take a minute or so. Okay. All right, it'll take a couple of minutes to upload, but in the meantime, I'm going to clear this, and I'll start reading. Question number 10 is where we're up to over here. Question number 9, excuse me. It says the stock market comprises 4,600 shares of stock A. There are two stocks. I'm going to put A over here and stock B over here. And so we're told that there's 4,600 of shares of stock A, 4,600 of stock A, and 1,600 of stock B. This is the number of shares. And it's still taking a while for it to load, but maybe you have it printed out. Okay, assume the share prices for stocks A and B are $15 and $30 respectively. $15 and $30, okay, good. And then it tells you if you have $15,000 to invest. I'll just put that up here. You have $15,000 to invest, and you would like to hold the market portfolio. Market portfolio means you want it in the same percentages as the market as a whole. You want to invest the $15,000 in a way that is equivalent to what these are. Okay, there we go. That should be a little better. 5, 6, 7, 8, 9. Okay, there we go. That's where we're up to. All right, so the first thing we have to do is we have to figure out, okay, what percentage of this market is A and what percentage of this market is B? Percentage of the market for A, percentage of the market for B. How would we do that? Well, we have to figure out the total value. Oh, well, first we have to figure out the values. You know, the value of the combined stock. In other words, 4,600 shares times $15. So I'll say the value of A altogether is 4,600. This times this. Let's make this a little wider. Okay, 69,000, and B is 48,000. 1,600 times $30. So now I want to figure out the percentage of the market. How do I figure out the percentage of the market? Well, let's get the sum of this. Let's get this. Let's get the total amount of the market, which turns out to be 117,000. So I'll take for A this divided by the total, which gets us to, and this is a percentage, which gets us to 58.97%, and then B is this divided by the total, which gets us to, well, 41.03%. Okay, so we know that A is almost 59% of the market, B is about 41% of the market, which means of the $15,000, what I want to do is I want to invest this percentage in A and this percentage in B. So let's say my investment, which was the question, how much would I invest in each one? So what I would do is I would take 15,000, right? It only asks about A, but we can figure out both. It's really close to about the same amount. And then we could take the 15,000 and multiply it by this. 59% of 15,000, which turns out to be $8,846.15. It didn't ask for B, but it takes very little extra time to figure out what B is. B is the remaining $6,153.85. If we add these two up together, what are we going to get? Obviously, if we add these two, we got to get 15,000 because that's the entire portfolio. Yes, you can. Absolutely. You can buy, sometimes if you place an order saying I want to buy $2,000 of this particular stock, you might end up getting 31.784163 shares. You can get tiny little fractions because you can buy a stock, you can buy I want 100 shares, but you could also say I want $1,000 worth of this stock, and they'll give you whatever percentage that turns out to be. All right, number 10. What do we got here? This time we got something a little bit more complicated, and that is the portfolio of 3 shares, 240 shares of Yahoo, 150 shares of General Motors, and 40 shares of the SPY, Standard & Poor's Index. Okay. Then they give you the prices per share at 30, 30, and 130. Calculate the portfolio weight of Yahoo and GM. Okay, here obviously I already had it in a different window, so I'll just copy and paste it for you. this would be the way you would do it. Just set up a little spreadsheet over here, Yahoo GM and SPY. These are the number of shares given in the question. These are the prices given in the question. So we want to figure out the portfolio weight. That's exactly the same thing as we just did in the previous question. So how would we go about doing that? Same thing as we did last time. Let's get the value of each one, right? So let's do this number of shares times the price per share, which gets us, and again we want dollars, not percentage, $7,200, okay? And then we could use the same exact formula for this and this. We've got $4,500 and $5,200. Now if we want the weights, well, we need the total. So I'll take the sum to figure out what the whole portfolio is worth, which is 16,900. So then for Yahoo, what I will do is I will say this divided by the total, and that will give me the weight. And by the way, by E7, I'm going to weight it down with dollar signs because I want to be able to apply the same formula. Now, when I apply this formula to the next two lines, it'll keep the 16,900 as the denominator because I weighted down the denominator like this. So Yahoo becomes what percentage? And again, I'm going to want percentages here, not dollar signs. Yahoo is 42.6% of the portfolio. GM, which is the second part of the question, is 26.63%. SPY, which they didn't ask, but we'll figure it out anyway, which is 30.77%. And again, obviously, if you add them all up, you had better get 100% of the total, which you do. So the answer to the question is basically the same question as we had last time, except the previous question, except this question had 3 stocks, and the other question had two stocks. You want to figure out the weight? No problem. Just figure out the total value, not the value per share, because it matters how many shares you have, and not the number of shares, because it matters what the value of each share is. So just figure out the total value of each share of each security, and divide that by the total value of the portfolio, and you get the weight of that particular stock in the portfolio, which in this case would be 42.6 and 26.63. Question number 11. Okay, let's put this here. Okay. SAP Incorporated received a $1.5 million grant under the SBA Small Business Innovation Program. It invested the grant money and developed a system to remove metal contaminants. So how much did it invest? So I'm gonna, without even thinking about how to do this, I'm just gonna start writing stuff down. Exactly. So I'm gonna put 1.5 million. Let's put in dollar signs. Make this a little wider. All right. So the investment is 1.5 million. All right. The firm estimates that each shipyard spends $500,000 a year on stormwater cleanups. And of course, that's what this company is making. This company is doing the cleanups. It's removing metal contaminants, so it's doing the cleanups. So its revenue per yard is $500,000, right? And it also says it's able to sign and retain 4 shipyards, which means our total revenue is 4 times this. That's right, which is 2 million. Good. Okay, so the total revenue per year, actually, right? Because this was revenue per yard per year. So this is the total revenue per year. All right. It also tells us what is the present value of the project, net of the investment, if the total cost of capital, which we'll call the COC, is 14% per year. Okay. Assume a cost of operations and other costs equal 50% of the revenue. So, I'm gonna insert a little thing I'm going to put in the net revenue, because the net revenue is the real cash flow. Obviously, the gross cash flow is meaningless. The net revenue is only 50% of the revenue. So the net revenue per year, one second, the net revenue per year is only half, so I'll say this divided by 2. Okay, so assume a cost of operations and other costs equal 50% of the revenue. So how would we go about figuring this out? It doesn't give us a number of years. So that's the problem. The problem is it doesn't give us a number of years. So if it doesn't give us a number of years, how do we figure out the present value? It's right. It's a perpetuity, absolutely. A company it's not going to last in perpetuity. It's not really going to last forever. But for our purposes, you can assume it's going to last forever because there's no limitation. How do you figure out the perpetuity? Again, let's call the present value of the perpetuity, which is always the cash flow divided by the rate minus the growth. In this case, there's rate, and it doesn't say anything about growth, so there is no growth. So it's actually the revenue, which is $1 million, divided by the rate, which is 14%, and there's no growth. So that means the present value of the perpetuity is $7,142,857. But note, is that our final answer, by the way? Not quite, because it wants us to do it net of the initial investment. That's right. So the net present value, the net present value is this minus the initial investment, which was this, and it turns out that the total project is worth $5,642,857.14. All right. Question number 12. This, by the way, is the other question that was probably a little bit more complex than I'd want to generally put on an exam, but we can go through it, of course. Let me zoom in a little bit here. All right, assume the market value of Ford's equity, preferred stock, and debt are $7 billion, $4 billion, and $10 billion, respectively. This is a weighted asset cost of capital question. Remember, weighted asset cost of capital had three elements. You had the weighted cost of the regular stock, the preferred stock, and the debt. Those were the three elements. So we've got three over here. We've got regular equity, we've got preferred stock, and we have, what else? We have debt. All right. So what does it tell us about the equity? The market value of the Ford's equity is $7 billion, and we'll call it. Let's do it in millions. So I'll put this as 1,000 because we're talking about, again, in millions. So that's 7,000 million. Preferred stock is 4, and debt is 10. So that's 10 billion. These are the market values. Okay. What else does it tell us here? Ford has a beta of 1.4. Again, I don't know exactly where that's going to be relevant. Well, I know where it's going to be relevant, but let's just put it aside. The beta is 1.4. Okay, we'll leave that here. We're going to need that a little bit later on. Ford, the market risk premium is 6%, and the risk-free rate is 4. The market risk premium is 6%, and the risk-free rate is 4%. Whoops. All right. What other information do we have over here? Ford's preferred stock pays a dividend. All right. Preferred stock pays a dividend of $3 per year. Again, we're just talking about the preferred stock has a dividend of $3 per year, and it trades at $25 per share. Okay. Ford's debt trades with a yield to maturity of 8.5%. So the cost of the debt, or the cost of capital for the debt is what? 8.5%. And it also tells us that its tax rate is 35%. Let's put that down here. All right, is that enough information for you? All right. So, a couple of things. First of all, we are going to basically what this question does is it makes you figure out the value, the cost of equity in three different ways. We learned about several different ways of figuring out the cost of equity. One was the capital asset pricing model. If you remember, we did this at the very end, I believe, of last time. I think we did that this week. The capital asset pricing model's method, I'm going to write them here. Under the capital asset pricing model, sorry about that, not looking so, okay, anyway, the cost of equity, again, these are formulas that we covered, so hopefully you have them printed out, is the risk-free rate plus the beta times the market risk premium. That was one way. That was the capital asset pricing model's way to figure out the cost of equity. There was another way to figure out the cost of equity. We actually did an example where we did both ways with the same company and came up with a slightly different answer, which is fine. The other way to figure out was the dividend divided by the price plus whatever growth. Everybody remember these formulas? Again, if you don't remember, that's fine. They were on the slides in the previous class. Here, this gives us enough information to figure out each one separately. If you notice over here, it gives us these numbers to figure out what the cost of equity for the equity is. It gives us these numbers to figure it out for the preferred stock. And for the debt, it actually gives us the cost. It actually gives us the cost of debt, which is the same thing as the cost of capital, outright. Let's figure it out for the equity. Let's use the capital asset pricing model, because for the equity, we've got these things. These are all things that apply to the regular stock for a company. So, for example, this would be the risk-free rate, which would be this, plus the beta times the market risk premium. So it turns out that the the cost of equity for the regular stock, the regular equity, is 12.4%. What about the preferred stock? Well, preferred stock, we don't, this stuff only applies to the regular stock. This doesn't necessarily apply to the preferred stock. But fortunately, the question gave us this information necessary to get the preferred stock's information. It gave us the dividend and the share price. So for that, we can say equals 3, which is the dividend, divided by the share price, which is 25. There is no growth, doesn't say anything about growth, so we can just say equals 3 divided by 25, which turns out to be 12%. What about the debt? What's the cost of capital for the debt? What's the cost of equity for the debt? It's not quite 8.5. It's close, but what's one more factor you have to take into account? Remember, this is interest that the company is paying. If the company is paying interest, so it doesn't have to pay interest on the taxes, because the taxes it's saving the tax money. Right, so what we'd have to do is we'd have to do equals 8.5% times 1 minus the tax rate. Now 1 minus 35% is 65%. So it turns out that the cost of equity on the... No, 1 second. This should be 8.5%, not 0.85%. So times 65%, again, because 35% of it is saved on taxes, and it turns out to be 5.53%. So now we've got the 3 cost of equities. Okay. Now, to figure out the weighted asset cost of capital, we had to multiply the value of each one, or the percentage of the portfolio for each one, times the cost of equity. So in other words, these are the 3 cost of equities. Now we have to figure out the weight of the portfolio for each one. Well, for that we have the numbers, and we have to figure out what's it of the value of the whole. The sum, of course, of this is 21 million, really. So for the weight of each one, we can use this divided by this. And I'll put the dollar signs over here to lock it in. And I'll turn it into percentage. This is 1/3 of the portfolio. This one is 19% of the portfolio. This one is 47.66% of the portfolio. If we extended this out, yeah, okay, something like that. Okay, so the thing that's attributable to each one is the cost of equity times the weight. One second. Alright, I don't know why it decided to come to so many digits over here. I'm going to put this back over here. Yeah. Alright, and again, we can do that for the other two as well. And then, so to figure out the total weighted asset cost of capital, we'd add them all together. Again, a very complicated problem. Again, I wouldn't give you a problem like this on the exam, but the point of this is to illustrate all the different methods of figuring out the cost of equity. We use the capital asset pricing model because they give us the beta. If they give you the beta, the market risk premium, and the risk-free rate, use the capital asset pricing model. Use this one. The risk-free rate equals plus the beta times the market risk premium. If they don't, use the dividend divided by the price plus growth, if any. Debt, they kind of have to give you. They'll usually call it, the rate or the yield to maturity, but it's the same thing. But of course, account for taxes. You have to subtract whatever money you save in terms of taxes. All right. And finally, our very last question. A firm has outstanding debt with a coupon rate of 8%, 9 years maturity, and a price of $1,000. What is the after-tax cost of debt if the marginal tax rate on the firm is 40%? Okay. Well, first of all, what is the cost of equity for this? It's 8%, of course, because the thing is, it tells you specifically it's paying out 8%. The price is $1,000. The present value is $1,000. If you wanted to figure out the rate, you could do, you could do, the rate formula, but it's not even necessary. I mean, the number of periods, it really doesn't matter what the number of periods is. It could be any number of periods. So we'll say 1. The payment is 8% of $1,000, which is $80. Thing is, the present value is $1,000, and the future value is also $1,000. So you don't even have to do this. Obviously, this is paying 8% a year. So the cost is 8%. So the cost is 8%. So that's fairly self-explanatory. All right. What is the after-tax cost of the debt if the marginal tax rate is 40%? The tax rate is 40%. How do you figure out the after-tax cost? Well, all you need to do is take the cost and subtract the tax rate. The tax rate is 40%. So what's left over? Because again, that's what you're saving. The company, by paying 8%, it's saving in taxes 40% of that. So the only thing it's actually costing is the rest. So it's really just the 8% that it's paying times the 60% left over. Or 6 times 60%, because 40% is being saved from having to pay taxes on it. So the remaining is 40%, and we have 48, where if you convert it into a percentage, it would be 4.8%. Again, I think it's fairly self-explanatory. It's simply 60% of 8%. And 60% of 8%, you can do it on a calculator, you can do it in your head, is 4.8%. Okay, so those are, well, it's amazingly, it's just almost exactly the top of the hour. So that was timed pretty well. So again, 5 and it really doesn't matter the number of 9 years, the amount to maturity. Now, if they give you a different present value, like if they said the present value was $900, then yeah, then you'd have to figure out the rate using those things. But when the present value and the future value are the same thing, you don't have to start worrying about the number of years to maturity, because it's always going to be 8%. The cost is going to be 8% a year. You could figure out the rate, but it's going to be 8% by definition. It has to be 8%, because if the present value is 1,000, the future value is 1,000, you're paying 8% a year, well then the cost is obviously 8% a year. Alright, so again, if anybody has any questions in general, I encourage you to please either shoot me an email or post them to the message board. I will certainly be monitoring